Lesson 1. Don't listen to Americans. I learned to invest as a young banker on Wall Street in America 18 years ago. But then I moved home to Europe and everything was different. You've got different brokerages, different investments, different regulations, different tax rules. And even with my skills, it took effort to figure this out. Too many Europeans read some American blog, watch an American video, and get stuck trying to buy ETFs, which you can't even buy here in Europe. So lesson 1 is this: don't take American investment advice if you live in Europe. Lesson 2, don't take your bank's advice. I discovered this immediately when I moved to Europe. Virtually all the investment products sold by my local banks were just incredibly expensive. The results were really poor. You couldn't make any money. I got so frustrated by this that together with some partners, we built an investment company to solve this problem, which, by the way, became really successful, but that's a whole different story. The point is, don't go to your local bank for advice because what they want to do is sell you their expensive products. So what do you do instead? Well, let's look at lesson 3, which is all about what are the best investments to buy. As a young investor, I felt overwhelmed by all the different choices. You've got real estate, stocks, bonds, gold, options, forex, day trading. What's a smart investment and what is just risky gambling? Well, when you look at the data, it's pretty obvious. The biggest investment categories in the world by size are real estate, bonds, and stocks. That is where the vast majority of the world's wealth is. Now, real estate can be a great investment, but it's a lot of work. Bonds are excellent for safety, but they're not very profitable. So that leaves stocks as the ultimate long-term investment. If you look at centuries of profit data, stocks, along with real estate, have been the most profitable investments. And that shouldn't really surprise you. When you buy a stock, you buy part of a company. Buy some Amazon stock, and you own part of all their warehouses, all their offices. You've got all their many employees working every day to make you richer. So this is why stock investing has created literally trillions of euros of wealth for investors over the years. Before you rush out to buy your first stock though, here's lesson number 4. Don't buy individual stocks. I'm a professional investor, but I almost never do it. Now, sure, when I started on Wall Street 18 years ago, I imagined that successful investing was all about combing through the thousands of different stocks out there to find the next Google or Amazon. A few amazing investors like Warren Buffett or Peter Lynch have been really successful with that. But as it turns out, most people who try it, including most experts, get really bad results. And that's because individual stocks are bad investments. According to research from Professor Henrik Bessenbinder, there were around 26,000 individual stocks in the American stock market over the past 90 years. 11% of all those stocks went to zero. Investors lost everything. The average stock in the market, if you picked one at random, it lost at least a bit of money. In fact, virtually all the big profits of the stock market, the whole reason stock investing has been so profitable, came from just a few successful stocks. Over those 90 years, just 83 stocks created half of all shareholder wealth. That is 83 stocks out of 26,000. Talk about finding a needle in a haystack. Unless you've got the time and skill to search through thousands of financial models and annual statements and news reports to find these winners, lesson 4 is for you. Don't pick individual stocks. Now, maybe you don't believe me. When I teach investing courses, my students often say, sure, most stocks lose money, but I'm not going to buy most stocks. I'm just going to buy the best stocks like Nvidia or Amazon or Google. Where's the problem with that? To win at stock investing, it's not enough to buy successful companies. For example, General Electric, GE, has been a hugely successful company for decades. Between 1985 and 2005, GE stock returned 16% per year on average. In 2005, GE was the 5th biggest company in America, according to the Fortune 500 list. Back then, it would have seemed like an obvious investment. But then, between 2005 and 2025, the stock returned only 5% per year on average. In fact, I took the 10 biggest companies in the S&P 500 in May 2005, and I calculated their profits between then and today. And of those 10 companies, only 2 stocks, Microsoft and Walmart, outperformed the S&P 500. The arithmetic average return of these 10 stocks was just 4.4% per year, much lower than the 10.7% of the S&P 500. Here's the problem. Once a company is big and successful, once the stock is hot and everybody knows about it, usually the stock price is already very high. If you want to be really successful at stock investing, you can't buy at these expensive prices. You have to find the next Nvidia, the next Facebook, the next Amazon before they become big, before they become famous. And this is incredibly difficult. The same applies to sector investing, by the way. Maybe today you want to invest in hot sectors like semiconductors or AI or European defense stocks. Well, before you do that, look back at history. When I was starting out on Wall Street, everybody said the world is running out of oil. Energy prices were sky high and energy stocks were hot. Everybody jumped into these stocks hoping to make a lot of money. But then, some years later, the price of oil collapsed, and a lot of those investors lost money. Or remember the late 90s. Everybody was super excited about internet companies like Yahoo or Pets.com. They were going to change the world. And look, that prediction was not wrong. I mean, internet companies did change the world, but they didn't do it fast enough. Before that, first you had the dot-com crash. Internet stocks just crashed and burned, and a lot of investors got wiped out. So that's my lesson number 5. Hot stocks and hot sectors are often expensive. They are rarely the best investment out there. So if it's so hard to pick winning stocks or winning sectors, what's the alternative? How do you invest in the stock market? Well, this next lesson, it's something that felt incredibly counterintuitive to me when I was starting out. But if you want to succeed at stock investing, you should aim for average results. That sounds crazy, right? Your parents probably never told you, son or daughter, I want you to grow up to be average. You never dreamt of being an average doctor or average engineer or average software developer. But the paradoxical thing is, in stock investing, if you can get average results, you are actually in the top 10% of all investors. Now, the key is you don't want to get the results of the average investor. You want to get market average results. And here's the difference. As we saw, most stocks in the market are actually losers. So the average investor who tries to pick some stocks does badly. But the stock market as a whole has been incredibly profitable. So if you build a portfolio which is a miniature copy of the whole market, if you buy a little bit of all the stocks in the market, including tomorrow's big winners, then you get some amazing results. Over the past 50 years, the average profit in the global stock market has been around 9% per year. That would have taken $10,000 invested in 1975 to $745,000 today. But how do you do this as a practical matter? How do you invest in the whole market so you can get these amazing results? Well, 50 years ago, there was no easy way, but today anybody can do it. You simply buy index funds and ETFs. So index funds and ETFs are simple funds where you put in your money and the fund invests it in hundreds of different companies globally. You get the average profit of the global stock market minus a low fee. Warren Buffett recommends these funds. I invest the vast majority of my family's wealth in these funds. And back when I was a pension fund CEO, I used index funds and ETFs to invest hundreds of millions of euros for my clients. And this is how we got our clients the best results in the whole country. So I'm a big believer in this 6th lesson. To win at stock investing, buy index funds and ETFs. But even buying index funds and ETFs won't get you optimal results if you haven't learned the next lesson. Because here's the problem. Most index fund investors do not get index fund results. Let me explain that. So I started my career on Wall Street back in 2007. This was at the tail end of the housing bubble, right before the crash. There were so many people around me who were excited about stock investing, buying index funds, getting into the market. That's because for years before that, the stock market had been going up and up and up and up. Then the crisis started. Stock markets crashed and they kept crashing and crashing and crashing. And I remember sitting on the trading floor in early 2009. The market was down 50% at that point. Now, objectively speaking, that was a wonderful time to buy stocks because they were really cheap. But everywhere around me, I saw terrified people. Even professionals were scared. Not that many people were excited about buying stocks in early 2009. This always happens. Investors pile into the market when the market is doing great and everything is profitable, and they don't invest when the market is down and the news are scary. Although those are often the best times because you're buying stocks cheap. This happens to index fund investors too. So as a result, the average index fund investor underperforms the average index fund. According to the Morningstar Mind the Gap report, over the past 10 years, the typical underperformance was 0.8% per year. This may not seem like a lot, but over the years it makes a huge difference. So my seventh lesson is this: don't buy high and sell low. But why not do the opposite? Why not only buy stocks when they are cheap? Buy the dips. Well, as a young investor, I had the same temptation, but it almost never worked, and here's why. Take a look at this graph. Is this a market high? At this point in time, should you have bought stocks or should you have waited for the market to fall a bit? I mean, it looks expensive, right? The market has been going up for a long time. Maybe you should have waited, but actually this was January 2017. Between then and today, the market has never been that low again. If you waited for the market to fall, you would have kept waiting forever. Now look at this graph. Is this a market low? Is it a great buying opportunity? Well, this was actually August 2008. The market dropped another 45% from this point. The problem is, market highs and market lows are only obvious when you look back. You cannot predict what's going to come next. This is why Robert C. Merton, the Nobel Prize winner, called market timing a fool's errand. And if he couldn't do it, you and I probably can't either. But that raises a question. When should you invest? What is the best time to buy index funds and ETFs? Well, basically, any time that you've got some free cash. The best approach is to invest every month, no matter what the market does. So that's my lesson number 8. Don't time the market. Just keep buying on a regular basis. Now, when I say this today in 2025, people often object. They say, just keep buying made sense in the past, because in the past, stock prices were reasonable. Right now, stocks are crazy expensive. US stock valuations have almost never been this high. Buying stocks right now is just stupid. Well, there's two ways to look at this. First, there is a reason for the high US stock valuations. The US stock market is different than it was in the past. It's dominated by these tech companies, which, first of all, are profitable, and second, they're growing very quickly. We are in the middle of the AI revolution. So there's a good argument that these high stock prices can be justified. But let's assume that's not true. Maybe the AI revolution is just an overhyped bubble. Maybe buying these American stocks is a bad idea. Well, this brings me to my 9th lesson. And if you were not good at geography in school, this might be a shock. But listen up. America is not the whole world, and the American stock market is not the only possible investment. Now, sure, the American market has been the most profitable over the past few decades. It is the biggest in the world. It has the biggest companies. But there are many other diversified markets that you can look at, such as European or Canadian or Australian stocks or emerging markets. And in many of these stock markets, prices are not nearly as high as in America. This graph shows you average PE ratios, stock valuations in different regions. This line is America, this one is Europe, this one is Canada, and this one is Australia. Not everywhere is super expensive. So that's my lesson number 9. If you want to avoid high stock valuations, look outside the US. Okay, so the good news is that with index funds and ETFs, investing is easy. You press a few buttons, you put in a bit of money, and you are invested in hundreds of different companies around the world. But there is a challenge here in Europe. Which ETFs do you choose? What investment app is best? And how do you handle taxes? Well, I've actually put together a training which explains all this. To watch it, just click the first link in the description.